Hello, good morning. I am Avnish Jain. Welcome to the monthly debt outlook from Canara Robeco. Let's look at the global situation. Global situation remains two-pronged. On one side, the war in Ukraine, Russia, and in Middle East continues to have its impact on the commodities market. On the other hand, all other markets remain sort of insulated from these actions, these geopolitical actions, because people believe that these things will remain contained and will not broaden beyond the borders they are fighting. In terms of macroeconomic data, US markets are finally looking forward to the first rate cut. We have already seen rate cuts from the European Central Bank as well as the Bank of England, which cut rates by 25 basis last month. The US data is moderating now, with inflation trending towards the 2% range, as well as the labor data remaining weak, pointing towards a flagging economy. The US Federal Reserve is expected to cut rates in the September policy. It was sort of also announced in advance by the US Chair Jerome Powell in his yearly Jackson Hole speech, where he pointed that rate easing is now on the cards. Markets expect a 25 basis rate cut in the coming policy in September or mid. From the market side, the US yields have trended lower in the last 2 months from a high of about 470 we saw in probably April or May, and now around 390. They touched a low of 370, but the expectation of a larger rate cut is now kind of not there. Markets were expecting a 50 basis rate cut in the first policy meet itself, but the recent data shows that Fed may be looking only at 25 basis rate cut. Overall, market is expecting about 75 basis rate cut in the current calendar year 2024. Coming to Indian markets. Indian markets remain resilient. The growth is resilient. The latest GDP number came at 6.7% as expected. The GVA was around 6.8%, more than expectation. So overall, the situation remains quite robust. Inflation tended lower to a lowest level of 3.5% in July reading. However, this was largely due to base effect. The next two numbers may be a little higher and closer to RBI's expectation of around 4.5%. Overall, RBI policy has been on the restrictive side, and they have shown no inclination of moving towards easing despite US rates coming down. Markets expect that probably RBI will remain in status quo mode in October as well, despite a 25 basis rate cut policy expected by the US Federal Reserve. This is of course because India's growth remains resilient and inflation is more near 4% range where RBI wants it to be. The RBI Governor, Mr. Das, has reiterated again and again that inflation is a focus now and they would not be looking at a rate easing till inflation is trending towards 4% range on a durable basis. This puts a lot of attention on inflation by the RBI and the Monetary Policy Committee. We do not anticipate that RBI will cut in October policy. However, if Fed cuts faster in this year, RBI may be prompted to also follow with a small cut of 25 basis rate cut, just to ensure that the currency markets remain in sync with the global markets. Overall, the market conditions have been easy in looking at the yields trending lower over the past 2-3 months. Again, we saw in first quarter yields topping around 730. They are around 685, 690 range now. We are talking about the Indian 10-year yield. The markets have been closely following the global cues because the local cues have been absent because of RBI's insistence on not cutting rates or even changing stance to neutral in their policy. So what we have been looking at is that markets have been following global markets, and as the overseas yields have come down, our yields have also followed suit. There is another big reason is that due to inclusion of Indian government bonds in the JP Morgan Emerging Bond Index, there have been large flows in the last 6 to 8 months. In 2024, current year to date, we have received almost more than $13 billion in Indian debt markets, principally in government bonds. This has continued to support markets in weaker times. These flows are expected to continue till March of next year, till the exposure in the JP Morgan index is adjusted to around 10%. This will continue to support markets going forward. Also, The Indian government also has done its bit by keeping the fiscal consolidation in progress. The fiscal deficit for FY25 is now projected at 5.9% versus 6.1%, which was earlier envisaged in the interim budget in February. Also, the government is committed to bringing down fiscal to 4.5% by FY26. This has further enthused markets who see lower government borrowings continuing to support G-Sec markets. Overall, market yields should trend lower, but if there is no rate cut pending from RBI, we do not see any major rally in G-Sec yields. They will continue to follow global events in the short to medium term. But for the investors, what is the choice of investments right now? If we look at the yield curve, we find that the 1-year yield is on the higher side as compared to rest of the yield curve. This is because RBI has been on the restrictive side and there have been no rate cuts and liquidity tends to be on the deficit side. This has kept the short end of the yield curve on the higher side, while the longer end has reacted already to expectations of rate cut in the future in the global market as well in the local market, probably next year. When money market yields are higher, money market funds like low duration fund and ultra short term funds tend to do well. We expect that as and when RBI shifts to neutral or possibly goes for the first rate cut, this segment would perform better than the longer end of the segment. For investors, they may choose to invest in these funds based on their risk and return profile. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.